So just a few days ago, the stock market hit all-time highs, new all-time highs. And there's a thought process that goes through a lot of investors' mind when they see the stock market hitting all-time highs, that when the stock market hit all-time highs, that means a crash is coming somewhat very soon, right? Because the stock market can't just keep going up, going up, going up, right? So I want to speak about that in this video. I got a bunch of important things to show you guys around valuations, about what's going on here, around sentiment in the market, those sorts of things. So I want to talk about that and kind of react to that at the front of this video. Then there's 3 videos I want to actually react to in this one here today. Liquidity sensitivity is still impacting markets. I think that should be an interesting one to react to. Small caps outperformed this week. Market rotation will be bullish over the short term. Looking forward to reacting to that one. And last one up here is this former Bridgewater, which is Ray Dalio's fund there. Bridgewater chief strategist has been skeptical about small caps. So looking forward to reacting to that one, getting in that one. Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. New all-time highs. Appreciate y'all. Pin comment down there today will be to join my private group if you're looking to apply to join in there. Okay. So Dow Jones Industrial Average, 40,000 plus this week, actually went all the way over 41,000 at one point there for just a quick moment, right? And so, yeah, a lot of people, when they see this going on, the Dow at all-time highs, the NASDAQ at all-time highs, S&P 500 all-time highs, there's like a feeling of like, man, this can't keep going, like this has to be a crash, those sorts of things, okay? No, I wanted to back this up all the way to 1950, okay? What I'm showing you is a Dow all the way backed up to 1950. So the Dow back around that time was around 200, we can call, somewhere around there, roughly, right? And today the Dow is about 40,000, right? So that just in itself should kind of hit you a little bit about like the market over the long term goes up substantially, right? Now also keep in mind, it's very natural for the market to hit all-time highs, and actually the market should be hitting all-time highs unless there's a freak situation, the market should be hitting all-time highs and all-time highs and all-time highs. Usually the only time period you get a real like downdraft in the market is usually if you're going through a Fed hike cycle or if you're going through a recession at that point in time. That's really the only time periods you should actually get the market to go down in any substantial way, right? This period we battled with inflation on and off that really just was brutal on the consumer for about a decade there, right? And it was a very, very tough time for the market. But other than that, I mean, it's up and it's up and it's up and away, okay? So the market should hit all-time highs. It's very natural for it to hit all-time highs. And then, you know what the next most likely thing is to happen when the market hits all-time highs? It hits another all-time high, okay? And then another one, and then another one, and then eventually the market breaks, right? And you get some sort of recession, you get something to happen. But that's just a little food for thought in regards to that. But let's be very clear, if you're going to get the market to break, you need to get 6 stocks to break, right? Because you got to understand the way the market's weighted nowadays, especially specifically the NASDAQ, and specifically the S&P 500, it's weighted based upon 6 stocks that are really the ones that run the whole market, and you have to get those stocks to break. Meta, Google, Amazon, Apple, Microsoft, and Nvidia. Those 6 stocks are such a huge weighting in the market that unless you get those 6 stocks to break, you're not breaking the stock market, okay? In terms of Dow Jones Industrial Average, that one's weighted a little differently. That one's weighted based upon stock price. It's a very bad weighting they do there. But in order for that one to break, you need to break United Health stock and Goldman Sachs stock, okay? And those are, generally speaking, very tough stocks to break as well, especially when it comes to Goldman Sachs, okay? But we'll focus really on the S&P 500 and the NASDAQ because that's what most people focus on. So are valuations at a point with these stocks that it doesn't make sense, right? Well, let's start with Meta, Google, and Amazon, the smaller of the big dogs, right? These are all $1 trillion plus market caps when it comes to Meta, Google, and Amazon. Amazon's over $2 trillion, but you know, let's start with those, and Google's around $2 trillion as well, right? So in regards to Meta, do we have a valuation problem here? Trailing 12-month P26 forward, P23 2-year forward, P19. With those sorts of growth rates, double-digit earnings per share expected here, and triple-digit trailing 12-month earnings per share. And then as far as trailing 12-month revenue growth, 21% on Meta. We're at a current year expected revenue growth of 19.5%. Next year, 14%. Meta, no. The only argument you can make of Meta is how undervalued it is. You can't make an argument that that stock is overvalued. So trying to get Meta to break is near impossible. You could get maybe small downdrafts in the stock, 5-10%. But in terms of getting that stock to really break, to have a crash down 50% is almost impossible now at this point in time, okay? You know, the valuation is just way too undervalued. Google McDougal, same exact thing as Meta. Trailing 12-month 26, forward P24, 2-year forward P19. Trailing 12-month earnings per share growth 45%. Trailing 12-month revenue growth 11%. Current year expected revenue growth 15%. Next year expected 11%. 33% current year earnings per share growth expected, and 16% next year earnings per share growth. Yeah, you can't get Google to break and crash in this market either. So Meta and Google, you can't crash those stocks. They're just too undervalued right now, right? That's tough. Amazon, way undervalued right now. Forward P 42, 2-year forward P 29. For Amazon, that's insanely undervalued. If you look at Amazon's history, try finding it many times at these sorts of forward P metrics. It's going to be very, very difficult to find the stock ever this undervalued before, right? Current year expected earnings per share growth 53%, coming off a trailing 12-month earnings per share growth of 749%. In revenue growth over the trailing 12 months, 12%, and then over the next couple of years, 12%, right? So you can't get Amazon to break either, right, and crash in this market. There's just going to be way too many buyers if Amazon has even the smallest dip. So in regards to Meta, Google, Amazon, you can't get those ones to break, so you can't get a crash in the market right now, right? Now, if we go to Apple, we go to Microsoft, we go to Nvidia. Now, this is where things could get a little interesting, because Apple is, we can call it a little richer valued. Forward P 32 on this baby. It's not very often you ever have seen Apple trade at a forward P in the 30s. Very, very rare, especially in the last, I would say, 10 to 15 years. Pretty darn rare for that to ever happen. So it is a little rich, but remember, there's been a fundamental change in the way Apple stock is viewed. So many years ago on the channel, I told you guys, Apple stock will start to be viewed as a services company first, right? And it will command a higher valuation. If you go back to my videos talking about Apple back in like 2018, 2019, 2020, you'll see that, right? And sure enough, that's what's played out now. And so people really look at Apple as a services business first, and then they look at kind of the hardware as just being like, kind of the cherry on top in regards to the situation. But the services just keeps piling in money, right? And so that's what we have with Apple now. And so if you're going to view it more as a services play, more of as like almost like a SaaS play as well, right? People are going to say, okay, that stock deserves like a 30 multiple on it, right? A 30 forward P, which is right around where Apple is, right? Now in regards to Mr. Softy, Microsoft 37, 35, 29, 2-year forward P. Keep in mind Microsoft is one of the best business models ever, right? If not the best business model ever. They just continue to collect those fees. People stay signed up for Microsoft products. They got their cloud products, right? And people just stay signed up for those year after year after year after year. And so they just continue to pull in revenue year after year after year, right? Very stable business model. Trailing 12-month earnings per share growth 25%. Current year expected 13%. Next year 15%. Trailing 12-month revenue growth 13%. 16% expected for this year, 12% next year. I mean, yeah, it's hard to make an argument that Microsoft's overvalued here. You make an argument that it's not as undervalued as you'd like the stock to be, but you can't really make an argument that it's overvalued considering the growth rates and considering it's one of the most stable, predictable business models in the history of mankind, right? So that's Microsoft. So it's very hard to get Microsoft to crash. I mean, believe me, if Microsoft went down all of a sudden 30%, I would be buying Microsoft shares personally, loading up a Microsoft stock. And I've never bought Microsoft stock. But if you put that baby down 30%, never mind 40, 50%, I'm going to be buying Microsoft, right? So hard to get that one to break. Nvidia, okay, this is a controversial one, right? Nvidia 68 trailing 12-month PE, forward P 49, 2-year forward P 33. So first off, we got to understand, like, this company's going to eat up those PE metrics here, right? Now, trailing 12-month earnings per share growth 755%. Current year expected earnings per share growth 232%. Next year expected earnings per share growth 33%. Trailing 12-month revenue growth 208%. Current year expected revenue growth 149%, and then next year revenue growth expected 33%. Listen. How can you make an argument that Nvidia is overvalued right here? You just can't. Not with those sorts of growth rates. Not with those sorts of growth rates. In order to get Nvidia to crash, you need to crash the growth rates for this company. And until that happens, you cannot get Nvidia stock to break. And so if you're wondering, when does Nvidia's business model crack? When do those growth rates crack there? My opinion is at the very earliest, 2026. And that's at the very earliest. It could be out to 2027 or 2028, though. But that's the very earliest. 2024 is basically a guarantee, in my opinion. 2025 is basically a guarantee. Listen to these big companies, what they're having to say about their CapEx for the next year or so. listening to a company like MU report, listening to what Jensen, the CEO of Nvidia, is talking about, they're set. So I think to break Nvidia is going to be very, very, very difficult. Now remember, Nvidia is also, it's not just about the short-term story, because I think that's what a lot of people get caught up into in regards to Nvidia, is like what's going on short-term. Oh, it's so exciting. Oh my gosh, right? It is very exciting. But let's not forget, Nvidia is one of the best long-term companies you could ever imagine. It's one of the best stocks in the last 10, 15, 20 years. The company's incredible, and they're going to continue to be incredible. As long as Jensen's leading that company, his company is going to continue to be incredible, and Jensen looks like he's not done anytime soon. He looks like he's more than happy to continue to lead this company for the next 10, 20 years. And so Nvidia is just in a sweet spot where they're going to keep innovating, keep changing the game, keep doing things that people never thought was possible before. They're a game-changing company. And so until that breaks, there's going to be buyers from a short-term perspective and a long-term perspective, right? And that's why even when you go through an Nvidia crash, some people look at the stock and they say it's overvalued, right? And people are happy to pick up shares when it goes through any sort of downdraft because they want to be in that stock long-term. Who wouldn't? Who wouldn't want to be in Nvidia long-term, right? So just a little food for thought in regards to that, right? By the way, 1000xstocks.com, if you want to apply for access to that, you can right now go to 1000xstocks.com and fill out an application for access to that. What I want to show you now, this is in the private group. We post this every Friday, right? The weekly investor report for everybody that's in the private group. And it's to get you caught up. We just go through a ton of metrics, ton of information to kind of let you know where the market's trading at, what's going on in the market, because I understand not everybody can pay attention to what's going on the day-to-day like I can, or some other folks that might be retired or something like that can, right? So first thing I want to show you here is AIA investor sentiment numbers. So in regards to that specific survey, which really looks at where investors are expecting the market for the next 6 months, people are incredibly bullish on this market, right? 52% bullish, 23% neutral, 23% bearish. So we're clearly under our historical average in regards to bearishness. We're clearly way above in regards to bullishness. And so somebody could look at this, right? And they'd say, oh, let me show you one more thing, and then we'll discuss that there. CNN Fear and Greed Index is another one that people like to look at for kind of like where sentiment is in the market. This week, we're at 49, which is a neutral in regards to fear and greed. So we're not in greedy territory in regards to this index. We're not in fearful territory. Last week was around neutral as well, 54. So as far as stock price strength, fear, stock price breadth is also fear. But then we also have put and call options in extreme greed right now. Not a ton of people are looking at playing put options right now, which could come back to bite people if they're not hedging their portfolios for next year. But I'm really looking at puts come this fall around Q4, especially if this market continues to go risk on, right? But let me show this here, because I think this is a more telling chart of people looking at this and like, people are way too bullish on this market. That means a crash is coming, right? Well, here's the deal. Look at this. Look at this. 1 year bullish high was back December 20th, right? December 20th, 2023. So let's go ahead and let's play this. Let's go 5 year here, right? And let's get this a little closer. And let's see. So back in December, we can say the market, or we can even say January, 38,000 on the Dow. So the Dow's climbed basically another 2,000 points since we reached our bullish high back in December of 2023, right? At least 2,000 points. And then if we were to pull up the NASDAQ, obviously that's substantially higher, right? Everything's substantially higher, the S&P 500. So you had a 1 year bullish high back in December 2023, and that's the highest it's been in the past year. And yet look what happened after that. We still went up and up and up in regards to the market. Look at how well so many stocks have done this year, right? I mean, so many stocks have had an incredible year. You could have said back in December, you know what, we can't go up any higher. We've reached the peak. We've reached the peak on this baby. That's it, man. People are too bullish on this market, right? And yet, let's pull up the year-to-dates of some of these stocks, right? Elf on a Shelf's at a 27% gain this year, right? Honest is at 13%. Palantir is at 72%. Oh my gosh, 72%. Meta, 37% on that one, right? Amazon, remember, these are big stocks that everybody talks about, everybody likes to own. 22% on Amazon so far this year. Nvidia, oh baby, they thought Nvidia was done last year, right? And yet, look at that stock, 144% gain this year. This year, folks. Let's look at Tesla Myesla. Tesla Myesla, what a crazy one that's been. It's down technically 3% for the year, but if you look at just the past few months, it's up like a ridiculous amount, right? And if we go to big tech, let's pull up the big tech watch list here. and see some of these babies. Year to date for AMD is up 9% for so far this year, right? If we already looked at Nvidia, let's look at the Qs just in general this year. The Qs are up 18% this year. Big dog Apple up 20% so far this year, right? Incredible. Netflix, 35% gain so far this year. Google McDougal, 28%. Jeez. Oh my gosh, right? So once again, you could have said easily, oh, market's peaked. People are too bullish, 52%. People are bullish on the market in the next 6 months. Yeah, we're due for a crash, right? And so, yeah, you can say that, but it's just like, it was wrong, right? It was wrong. And so if people can remain bullish, I've watched it where we've remained bullish for like 2-3 years straight. Like very high bullish numbers. If you can go back and you can look at the very detailed AI investor sentiment numbers, you can look at that very in depth. They have it on their actual website. You can track the data all the way back for like decades in the past, and you can look at the data. You can find we've had time periods where for several years the market remained very bullish as far as investors feeling bullish on the market for the next 6 months. So just a little food for thought in regards to that. Just because the market's high, just because people are bullish, doesn't mean that's the end of the market. The market's done. That's not really the way it works, okay? You have to get the actual stocks that run the market. You have to get those ones to break. If you can get those ones to break, then we're talking, right? Liquidity sensitivity is still impacting markets, right? And by the way, if you want to talk about getting those stocks to break, if you want to get those stocks to break, either these stocks have to go up a ton more so the valuations get way stretched where it's like, oof, the risk reward's not there, or you got to kill down growth rates until you get one of those two. Nope.
Missing 5,500. It looks like we're settling just above 5,500 here. Earnings, technicals, seasonality, politics, also geopolitics. I mean, what moves this market from here?
Well, I think what we've seen is some of the cracks that we were seeing emerging in financial market liquidity that were sort of showing their head in late June, early July, really became acute in a period where we got forced rotation caused by a short squeeze in short Russell 2000 positions held by hedge funds. And so what happened was you had a big shift in the market, not a lot of liquidity there to help contain those moves the way you would normally see. And I think overall, the big picture is the markets in aggregate, they've come down, right? Russell's outperformed, but they've come down a fair amount. That highlights the fact that this liquidity sensitivity that started to emerge a couple weeks ago, it looks like it's still there. And the trouble with that is it can be
Caterpillar, another huge stock in the Dow. You want to break the Dow, you got to break Caterpillar. Are you going to be able to break Caterpillar with all this insane government spending on infrastructure plans and things like that? That's another tough one.
Self-reinforcing. You get a couple of these days.
And are either politician going to kill off all the construction on infrastructure spending? No. B-Man's certainly not, right? And T-Man's certainly not either. You think T-Man wants to crash the economy? Give me a break.
And they create a continuous pullback from various players.
So maybe more to the shakeout here. Christina, the fact that we have seen this rotation, I realize it's softened a little bit here in the final several days of the week, but does it have legs?
Well, I do think it does have legs because I do expect the Fed to begin cutting rates by the end of the third quarter. The big if for the sustainability of the rotation, of course, is whether or not the Fed has been able to successfully avoid a recession, or if, in fact, what it has done thus far has created so much damage for the economy. And certainly we are seeing cracks appear in the consumer,
100%.
But nothing at the level that would suggest that we are going to see any kind of imminent recession. So my base case is that this is sustainable because we will see rate cuts and we will see an economic reacceleration coming in future months.
Okay. Now, Bob, looking now at the medium to long term as investors try to figure out what to do with their portfolio.
If you're wondering, we're seeing some cracks in the economy here, seeing some consumer weakness. Why hasn't the market started already price that in heavily and started to crash? You haven't gotten enough of it. The market has to see a sustainable major trend towards something before it freaks out over here. For instance, we already had an inflation problem back at the end of 2020, going into 2021, and the market didn't even pay attention. It didn't even care, right? And the market just kept melting up. It wasn't until we got into 2022, and then it was clear as day inflation was completely out of control, and it was clear as day the Fed was going to have to start hiking rates. It wasn't until that moment the market actually freaked out and then broke, right? You can go back to the great financial crisis. You know, there was already a lot of signs that the economy was falling off the rails back in 07, even into 06, right? Home builders all peaked around 05, 06, right? A lot of them peaked in 05. And so there was already signs that like, ooh, things might be getting a little shaky here, and then things kind of slowly got worse and worse and worse. And the market didn't flip out really until the second half of 2008, right? That was when all of a sudden the market completely lost it, when it was already obvious that we were donezo as far as the economy in the short term, right?
And maybe the impact of some of this political, the RNC was this week, and we heard a lot of things. We've heard about higher tariffs. We've heard about now a weak dollar from J.D. Vance as being some kind of a goal, and also a flat tax. All things that sound blue collar, but some of those things are in conflict with each other.
Yeah, in particular, I think the currency-related policy is a bit confusing in the sense of the implication of adding significant tariffs, which should be both supportive to the U.S. economy and also inflationary, are also supportive to the dollar by reducing our reliance on foreign imports. So that's a positive to the dollar. And then on the other side, talking about how the dollar should fall as a policy goal. I think the challenge for any policymaker in the U.S. government is currencies are notoriously difficult to control. So their policy that is much more probabilistic is that implementation of tariffs, which would be supportive to the dollar, supportive to U.S. growth and investment, but also inflationary. And so when you talk about that sort of medium to longer term, as we turn to 2025 and start looking there, are we going to be able to see this persistent disinflation, a soft landing in an environment where inflationary political policies are being pursued by possibly a new administration?
Oh, interesting. Okay, so Christina, if you're thinking about either dollar strength or the puts and takes around international stock investment, should you be thinking at all about how you expect this election to turn out at this point, or is it a fool's errand to make guesses on policy?
I would choose the latter. I think it's a fool's errand. If you think about the time horizon on an election, it's much shorter than the time horizon on most investors' portfolios. So, and of course, there's also the added component to this, which is that sometimes policies don't have the results one would expect, especially the impact on markets. So I would argue monetary policy matters a heck of a lot more than who is elected in November. And so that means focusing on what the Fed is going to do. And I think the Fed will, in fact, begin cutting rates, and that will cause a weakening of the U.S. dollar, at least a modest weakening. So a policy goal that might be stated by a candidate would be much more likely to be realized by the Fed.
Yeah, 100%. I mean, at the end of the day, the Fed really dictates, presidents, people in elected office, they can help exacerbate problems, whether that be recessions, whether that be inflation. They can help add fuel to the fire to damage those things or better those things, right? But at the end of the day, the Fed, it always really comes back to the Fed, right? So just a little food for thought in regards to that. Market rotation will be bullish over the short term.
Ed Clissold. Ed, wondering what your work is suggesting to you about whether this rotational move, this huge rush higher in smaller...
My man's old school. He's got the wired Apple headphones in. Wow.
And the broad list of stocks has good meaning on a forward-looking basis.
I love those, man. I forgot they had the little, you could adjust the volume. I forgot, man. I used to like those back in the day.
Yeah, so for the broad market, it does have a good implication because what you want to see are most stocks rallying together. What you don't want to see is a very narrow market where just a few stocks are rallying, everything else isn't. And we kind of got into that situation in the second quarter where the mega cap growth stocks were kind of the only thing going up. And so what this rotation has done is created a percentage of stocks above their 50-day moving averages, got above 70% earlier this week. That's a positive sign. And then we had another thing. It's looking at the 5-day advancing stocks. All those stocks went up in a day versus for 5 days in a row versus all the stocks that declined for 5 days in a row. And that got to a really high ratio above 3 times. So that when you get something that strong, it usually means the next few months are going to be positive for the market. So this kind of rotation for more boats rising with the tide tends to be bullish for the market.
And then,
you know what it is, to take it back to the whole all market's high, it's got to crash. It comes back to like what I call the roulette phenomenon. So, you know, I live in Vegas, right? And you go by a roulette wheel and you see they show you like what colors come up recently, what numbers, things like that, right? And you might see a trend. It might say like 7 straight times it's come up black. And you're like, oh my gosh, it's got to come up red. Like, come on, baby. And then it doesn't come up red. It comes up black again or green or something like that. And you're like, oh, come on, man. How's it not? That's what it comes down to. It's a roulette phenomenon where you think something's going, it can't keep going that way, so it's got to switch the other way. And it doesn't really work like that.
Put that into the context, I guess, of the general cyclical outlook, because it's all happening as we, I guess, are gaining some more certainty about, you know, soft landing, Fed rate cuts, perhaps the election. How does that filter through to your view?
Yeah, these things don't happen in a vacuum. They're happening for a reason, and it's the macro fundamental backdrop where, you know, a lot of people were looking for the Fed to cut rates at some point this year. We got some clarity with the CPI report and Powell's comments that September looks like the likely first cut date. And so now these small company stocks, a lot of whom, you know, haven't been profitable lately, so they need to borrow money to keep going. The lower rate environment means a lot more for them. And what you're seeing too is that earnings growth for small caps starting to look up. And then we have the political uncertainty of who's going to be in the White House. Look, the market has gone up under Democrats and Republicans, but the market likes to know who it's going to be, and whether or not you agree with it or not, you know, knowing that Trump's lead is widening the polls, you know, tends to reduce some of that political uncertainty as well.
Yeah, I guess who knows if that'll last for the next couple of months, but that certainly has been behind some of what's happened in the markets, no doubt about it. And then in terms of whether we're in a good spot in terms of how people are positioned coming into this tough seasonal period of the year, and whether you think that there is a higher risk of some kind of give back in the near term.
Yeah, so you look at a couple different ways. We have some sentiment indicators that we watch closely, and things probably a lot of listeners follow. The VIX index, the volatility put-call ratios.
So you know what's happening? You know what's really happening? So there's these certain things that are known in the market nowadays that are very famous, right? One is sell in May and go away. The other is people know that generally August, September are bad months for the stock market. So it's interesting because I'm watching these phenomenons play out where people are getting out the month before, but then the actual month, things don't actually go bad. So for instance, we can go back here in April, right? And all of a sudden the market just sells off, right? You know, look at the NASDAQ, the S&P 500 during that time. And then in May, it never actually sold off. It was not sell in May and go away, right? It actually was just up and away. And so now we could be going through a dynamic here, right? Where people are positioning out of stocks here at the end of July, right? Assuming the market's going to go down in August and September, like it does many times, right? And maybe they're right about that, or maybe they're going to be wrong again, just as they were when they were selling off stocks back in April, right? Interesting to think about it like that, huh? Interesting. It's like they're almost trying to time it out, but then it doesn't quite work that way.
Showing a lot of optimism, and so to think that the market couldn't have a bit of a pullback for a variety of reasons, interest rates pop back up, maybe some earnings disappointment, you know, could allow for the market to pull back here. But as long as the damage isn't too great in that trajectory of a few rate cuts coming up, decent year-over-year earnings growth, and the political uncertainty remaining far in the background, it means the market should be okay for the second half of the year.
In terms of that, you know, the massive advantage of advances versus declines and all these kind of breadth thrust things that happen in the small cap rush higher, it seems a little bit out of sync with perhaps arguably where we are in the economic cycle. Right? Isn't that the kind of thing that you would typically see, you know, kind of coming off a major economic low or some kind of, you know, the crescendo of a big market sell-off?
Yeah, that's when they happen most often. I would say the last decade or so, we've gotten a few more of these after smaller sell-offs. But here's a nugget that really brings it home. You know, last week after the CPI report, it was the fourth best day ever for the small cap Russell 2000 index versus the large cap Russell 1000. The other three were the day of the Black Monday 1987 crash, October 10th, 2008, when Lehman Brothers went belly up. And then we also had a couple days before the pandemic low in 2020. I mean, those were major market events. And this happened off of a CPI report. So it is a little bit different from when these things normally happen. But, the way we do things at NDR is we let the data speak for itself. And, a broadening of the market on balance is a positive thing.
Yeah, and I guess in some ways it's a measure of just how extreme the underperformance was recently in a decent economy leading up to that huge bounce. So who knows how we account for it. Ed, always good to talk to you. Thanks so much.
Yeah, so many consumer stocks would show you that the economy hasn't been good the last year or two, right? Next one up here on why this individual has been skeptical of small cap.
Rebecca Patterson is former chief investment strategist at Bridgewater. Rebecca, welcome. It's great to see you.
You too.
Okay, what do you say?
Rebecca, your camera's crooked. Come on, man.
They've got a glass of rosé, and they say to you, Rebecca, what do I do with my stocks now? Should I be chasing the small caps? Do I worry about the election? Do I stick with my Nvidia? What are you telling people?
Well, let's start with Nvidia and tech. I'm neutral right now. I think that there's obviously a lot of optimism priced in. It's a very crowded trade. At the same time, there's some very important structural benefits and comparative advantages of these companies, particularly the profitability, the free cash flow that allows them to constantly reinvest in their own innovation. So I wouldn't be running away from it. And maybe you even are looking at these pullbacks as an opportunity to add if you're not in there yet, which is hard to believe anyone out there might not be. But then beyond that, the small cap rotation, it was a violent move that we saw earlier this week, 11% in basically 4 days. And I've been skeptical about small caps really for the last few years, largely on the back of my own view that the Fed would keep rates higher for longer. And I think part of what saw this rally happen was some better inflation that allowed the market to price in a September ease and further easing ahead. So what do you do from here? To your question, I think it really is going to depend on two things. The Fed may feel inclined to cut September. We'll see if we get the data for that. The question I have, though, is next year. The market's still discounting about 115 basis points of easing next year. And the small caps are discounting that as well. So do you get that much easing? These companies need lower rates. They have relatively higher debt and more floating rate debt. The second issue is growth. Growth has held up relatively strong in recent months, moderating a little bit, but generally resilient. And even today, the New York Fed updated its Q3 GDP estimate to 2.7%. That's great. But there's other indicators saying we need to be cautious. If you look at jobless claims, they're noisy, but they're ticking higher. If you look at the service sector, the latest business sentiment survey, the ISM, had both employment and new orders contracting. So there's reason to still be cautious on that growth outlook. And to me, without having the all clear on those two things, I'd be nervous.
I will say T-Man's making a massive mistake in regards to one thing. So if you listen to the Bloomberg interview that came out, was that last week? Basically, T-Man was saying Powell shouldn't cut, trying to put pressure on Powell that he should not cut before the election, right? And he says that's a no-no. They know they shouldn't be doing that, right? Bad decision by T-Man. Bad decision. He needs the Fed to be cutting as soon as possible. There's Fed lags. Everybody that should know Economics 101 should know there's Fed lags, right? So if I was T-Man and if I'm confident I'm going to be elected, right? Make if anything, put pressure on the Fed to start cutting now. If the stock market goes up more because the Fed cuts, it's not going to mean you're going to lose the election, dude. If it was about the stock market, you'd lose the election. The stock market's at all-time highs right now, right? And yet you're looking great in the polls. Get the Fed to start cutting, because let's say the Fed was to wait. They're like, oh, we don't want to, cut around election time or right before election time. So let's wait till December to do a cut or January to do a cut. Well, the impact of cuts will not even be felt for at least until a year to 3 years after that. So you're not going to feel the positive effects till at least January of the following year. So if you're a T-Man, you're in office for 4 years, you want them to start cutting as soon as possible so then you can feel the positivity of those cuts out there. The longer you wait, you make the Fed wait, the more likely is you're going to have problems in the economy, and then you're going to have to play a game of cutting quickly, and then you're going to have to try to save the economy. It's going to be a mess, man. So, yeah, if I was T-Man, I'd be like, cut now. You don't want to wait to cut, because then you're going to have to deal with all that.
chasing or adding a lot more exposure broadly to small cap. It doesn't mean there aren't selective opportunities for active managers, but I certainly wouldn't be adding the small cap index in any size yet to my portfolio.
Wow.
Rebecca, one of the interesting topics of conversation, or even
I just think that's a mistake. I mean, you gotta get out in front of everybody. You know what I mean? Like, you can't wait for the gold. You can't wait for the Fed to actually start cutting to say, okay, now I'm going to get in. You miss a 20, 30, 40% move in an index doing stuff like that. I mean, 11% just in this week alone, right?
debates, if you want to characterize it as that I've had over multiple cocktail conversations or conversations with investor groups or investors, is the idea of how big a pullback could be. And one of the topics that was brought up was just how much leverage there is in the system. And that it seems like in the tighter rate environment that we're in, the amount of leverage that we have in the system chasing assets like stocks is not nearly as bad as it has been in other periods that have seen bigger market declines.
That's just facts.
I wonder if you can take us through whether or not you feel as though we can have a massive market decline if there isn't as much relative leverage as, say, back in the dot-com era or even during the 2008-2009 financial crisis.
Yeah, no, it's a great question. I love how you both are just kind of pulling in cocktail hour in your comments there, too. On
It's 5 o'clock somewhere, Rebecca.
Wishful thinking.
It's been a long week and a long day. Anyway.
These folks got drinking problems. That's all I'm going to say.
So with leverage, I think this is a really important point. Obviously, in the run-up to 2008, where we had that huge sell-off, the GFC, you had leverage among consumers, leverage among businesses, leverage in the financial sector. Today, the leverage is largely in governments. When we think about debt to GDP, that's where the excesses are. That's where the vulnerability is. And I think that plays out very differently in markets. But if I am looking for where is there some risk, one thing that I am very focused on right now is the retail investor. And you all have talked about this on air quite a lot, which I'm thrilled you are, because it's so important. We're back now to levels where the retail investor's role in the broader market is the biggest it's been since pre-GFC, pre-dot-com bubble. And that doesn't mean we're going to see the same result, but it does mean it's something we have to pay close attention to. You know,
once again, we keep it real simple. You want to get this market to go down substantially, you got to kill the economy for real. Not like, oh, you know, Starbucks is weak, Nike's weak, McDonald's. I'm talking about like kill it where like businesses aren't even advertising, which hurts like Facebook, which hurts Google, which hurts Amazon. Like, that's what you got to do. You got to devastate the economy in a massive way and kill these top of the funnel stocks. Until you do that, you just can't get the stock market to break. Until then, it's just a fairy tale in the end, right? So a little food for thought in regards to that. And then obviously, if the economy does actually get better over the next couple of years, if the Fed does start cutting, then that's obviously going to benefit a lot of these consumer names that have been beaten down, the Nikes and the Lululemons and the Starbucks, and we go through the whole long list of those type of stocks that aren't as important to the market, but are important companies in general, right? All right, guys, appreciate you joining me as always. Thank you so much for being here, folks. Thank you for being subscribed. If you're looking to apply to join a private group, you can click the pinned comment down there and apply for access to that, all my course curriculums, as well as our Discord chat. And then if you're looking for access to 1000X, you can go to 1000xstocks.com. Much love and have a great day.